Something is shifting in 2026 that could hit every retiree in this country, and almost nobody's paying attention. The folks who should be hearing about this, they're the last ones finding out. Now look, I'm not trying to scare you. I've got nothing to sell. I'm just a guy who put in his years, hung up his boots, and now spends too much time reading things that keep him up at night. And what keeps me up is watching decent, hard-working people, the kind who never missed a payment, never cut a corner, get blindsided by a system they trusted to work for them. If you're collecting Social Security, if you're on Medicare, if you've ever walked into your bank with a stack of cash from selling a car or a house or anything. This is the thing you need to understand before you make your next deposit, because I know a dairy farmer out of Maryland named Randy. Good man, honest man, and the government took $63,000 out of his bank account without charging him with a single crime. I'm going to tell you exactly how that happened, but first, I need to show you what's changing. Because once you see how this works, you'll know exactly what to do, and more importantly, what not to do. Right now, in 2026, when you deposit more than $10,000 in cash into a bank account, your bank is required to file a report. It's called a currency transaction report. They don't ask you. They don't warn you. They file it automatically, and it goes straight to a federal agency called FinCEN. Now, here's the part most people get wrong. That report, by itself, not a problem. It's not an accusation. It's not an audit. Banks file millions of these every single year, and almost all of them go absolutely nowhere. That's just the system working quietly in the background, and it's been working that way for decades. So, if you deposit $12,000 from selling your car, or if your daughter gives you $15,000 to help with a medical bill and you put it in the bank, a report gets filed, and that's it. You move on with your life. That part hasn't changed, and that part is not what this video is about. What this video is about is what happens when that deposit, that completely legal deposit, starts showing up in places you didn't expect it to. And in 2026, the number of places it can show up is growing. Look, right now, multiple federal agencies are expanding how they share financial data. The IRS, Social Security, Medicare, state-level benefit programs. They're all moving toward more integrated reporting. What that means, in plain English, is that a deposit you make at your bank doesn't just sit in a bank file anymore. It can get cross-referenced against your tax return, your reported income, your benefit eligibility, your enrollment in programs like Medicare Part B, Medicaid, SNAP if you receive it, even some veterans benefit programs. And here's where it gets dangerous for retirees. Most of these programs figure out what you're eligible for based on something called modified adjusted gross income. Some of them look at countable resources, which includes cash in your bank account. And here's the kicker most people don't know. Medicare uses a 2-year look back. Whatever income shows up on your tax return this year, that's what determines your premiums 2 years from now. So you sell your house in 2026, and in 2028 you get a bill you never saw coming. I was reading Fortune the other day. They had a piece about exactly this. Retirees selling their homes and walking right into a Medicare trap they never saw coming. A financial planner they interviewed called it the #1 mistake he sees. People selling their home after 63 without running the numbers first. He gave an example of a couple who sold with $300,000 in taxable gain. Their Medicare premiums nearly doubled, went from about $400 a month to over $800. And here's what makes it worse. The IRS lets you exclude up to $500,000 in profit from a home sale if you're married. Sounds generous, right? But that number hasn't moved since 1997. Home values in some markets are up 300 to 500% since then. That exclusion is covering less and less every single year. When a large deposit hits your account and that data gets shared across agencies, the system doesn't see a 71-year-old woman who sold her late husband's truck. It sees a number. And if that number pushes your recorded income or your resources above a threshold, even temporarily, even for 1 year, it can trigger a recalculation of your benefits. That means higher Medicare premiums. That means potential loss of programs that were helping you cover prescription costs or dental or vision. That means a letter showing up in your mailbox telling you your benefits got adjusted and you owe the difference. And the worst part? The system doesn't call you first. It doesn't ask for context. It doesn't want to hear that the money was a one-time home sale or a car sale or your own savings you moved from one bank to another. It sees the number, it runs the calculation, and it sends the letter. Let me tell you about Randy, because his story is exactly the kind of thing that happens when nobody warns you ahead of time. Randy Sowers was a dairy farmer out of Maryland. Ran a place called South Mountain Creamery with his wife. Good people. Worked that farm for decades. Woke up at 4 a.m, milked the cows, sold the milk, made the deliveries, cash business. Every week, Randy took his earnings to the bank and made a deposit. Here's the thing. A bank teller once told him, "Hey, if you keep your deposits under $10,000, it's less paperwork for us." So Randy did. Didn't think twice about it. He wasn't hiding anything. He wasn't dodging anything. He was just doing what the teller told him. Then, one morning in 2012, the IRS showed up. They said Randy had been structuring, deliberately keeping deposits below the reporting threshold, and they seized $63,000 from his bank account, just like that, gone, no warning, no hearing, no crime, just gone. Randy had never been charged with anything. Every dollar was clean. He earned it milking cows and delivering bottles. But the IRS took it anyway. And here's what really gets me. Randy fought it, testified before Congress. The whole thing took years. He eventually got about half his money back, half, after years. Randy did nothing wrong. The bank teller gave him bad advice, and the system treated him like a criminal for following it. That happened in 2012. And the law that let them do it, still on the books. In fact, just last month, February 2026, Congress introduced something called the FAIR Act to try to finally fix this. Bipartisan bill. They want to make the IRS prove criminal intent before they can take your property. The fact that they're still trying to pass that law, that should tell you everything you need to know. The rules haven't changed, and they still aren't being explained to the people who need them the most. All right. So now you've got the picture. You know how the reporting works. You know how the data moves between agencies. And you know that perfectly clean, perfectly legal money can still trigger a problem if the system reads it wrong. So the real question is, what do you do about it? I've seen 3 situations that trip people up more than anything else. And I'm going to walk through each one. Here's what goes sideways. And here's how you keep it straight. None of this is complicated. You just have to know the steps, and you have to do them in the right order. Number 1, a lump sum. You sold something for cash. A car, a riding mower, a piece of equipment. Or, and this is the big one, you sold your house. Downsizing, moving closer to the grandkids, whatever the reason. Either way, you've got a check or a pile of cash, and you need to get it into the bank. This is where most people stumble. Not because depositing the money is wrong, It's what they forget to do around it that causes trouble. Without any paperwork, here's what happens. The bank files its report. That number enters the system. And if it's large enough to move your income picture, remember, Medicare looks 2 years back. You're eventually going to get a letter you weren't expecting. On a car sale, maybe it's $60 a month. On a home sale, we're talking premiums that could double. So here's what you do. First, before you go to the bank, get a written record, a bill of sale for a car, a closing statement for a house, date, amount, buyer, signatures. Nothing fancy, just proof. Second, deposit the full amount. All of it, in one shot. Don't split it. Don't stash half in a drawer. Don't send your wife to a different branch with the other half. One deposit, clean trail. Third, and this is the one everybody misses, call Social Security or go to your local office and tell them this was a one-time event, not ongoing income. You file something called SSA Form 44. It's an IRMAA appeal. You attach your paperwork and send it in. You're not reacting to a letter. You're making sure the letter never comes. Number 2, a family gift. Maybe your kid did well for himself and wants to help you out. Maybe your daughter covers a surgery bill. Maybe a grandchild shares part of an inheritance. Here's the thing. A gift isn't taxable income for you. That's the law. But the money still lands in your bank account, and once it's sitting there, it counts toward your resources. If it bumps you past a threshold, the system doesn't care that it was a birthday check from your son. Now here's where it gets ugly, because this is where well-meaning families trip each other up. Somebody says, let's break it into smaller checks. Somebody else says, just trickle it in over a few months. Or, put some in your account and some in mine. I get it. It sounds smart, but every one of those moves is either structuring, which, again, is a federal crime, or it's creating exactly the kind of deposit pattern that banks are trained to flag. So forget all that. Take the full gift, deposit the full gift, and have whoever gave it to you write a simple letter. Their name, your name, the amount, the date, and one line that says, this is a gift, no repayment expected. Keep that letter with your bank records. That's your proof. And if the number is big enough to matter, file the same SSA 44 form. Don't wait for them to notice. You tell them first. Number 3, and I'm going to be honest, this one gets under my skin more than the others, because it's the one people get wrong for no reason. You're not selling anything. Nobody gave you a dime. All you want to do is move your own savings from one bank to another. Maybe you're closing an account after losing your spouse. Maybe a CD came due and you want it in your checking. Maybe you just want everything in one place. Here's the good news. If you do this the right way, there's nothing to worry about. Wire transfers, electronic transfers, cashier's checks. None of those trigger a currency transaction report. None of them show up as income. None of them affect your benefits. You're just moving your own money. The system doesn't care, but here's where it goes sideways. And I hear about this more than you'd think. Some folks don't trust the wires. They go to their old bank, pull out 20, 30, 40,000 in cash, walk it across town, and deposit it at the new bank. Now you've just turned a simple transfer into a cash transaction. And if it's over 10,000, the bank files a CTR. And now there's a federal report with your name on it, showing a large cash deposit with no obvious source. Because the report doesn't say this was a transfer from his other account. It just says cash. And if you took that bad advice I talked about earlier and broke it into smaller trips, 9,000 here, 8,000 there, now you're structuring, with your own money, a federal crime, because you didn't want to fill out a wire form. So here's the rule. When you're moving money between your own accounts, do it electronically. Wire transfer, ACH, direct bank-to-bank transfer, even a cashier's check works. Keep the closing statement from the old account and the deposit receipt from the new one. That's your paper trail. That's the whole thing. Don't walk cash across town. Don't break it into trips. Just move it the way the system expects you to, and you'll never hear a word about it. Now, let me address something I hear all the time, and it's flat out wrong and dangerous. People say, well, if I just keep my deposits under $10,000, the bank won't report it, and I won't have any problems. This is the single most harmful piece of financial advice going around among retirees right now. First, deliberately breaking up deposits to stay under the reporting threshold is a federal crime. It's called structuring. It doesn't matter if the money is clean. It doesn't matter if you earned it honestly. The act of splitting it up to avoid a report is by itself illegal. And this isn't hypothetical. There was a woman in Iowa back in 2013 named Carol Hinders. She ran a little Mexican restaurant, cash-only place, been open for years. Her mother told her to keep deposits under $10,000 to avoid paperwork. So she did. She wasn't hiding anything. Every dollar was from selling burritos. But the IRS seized $33,000 from her bank account. No charges, no trial. Just took it. It took her over a year and a team of lawyers to get her money back. Second, banks are not only watching for deposits over $10,000, they're trained to watch for patterns of deposits just under $10,000. You deposit $9,803 times in 2 weeks. That looks worse than a single deposit of $30,000. Not better, worse. Third, even if you dodge the bank report, the money's still in your account. If you're on Medicaid, SSI, or any program with resource limit, it still gets counted. You haven't solved anything. You've just added a federal crime on top of a benefits problem. Look, everything I just told you comes down to one rule. Deposit your money in full. Have paperwork that shows where it came from. File SSA Form 44 if the amount's big enough to move your income picture. And don't ever, ever chop up a deposit to duck under a number. That's it. That's the whole thing. If any of this hit close to home, tell me about it in the comments. Are you selling a house? Did your family help you out? Are you just trying to move your own savings without getting punished for it? Let me know your state too. Some of this plays out differently depending on where you are. Whatever you folks bring up the most, that's what I'll dig into next. You know what keeps coming back to me? How many people got that letter, read it, and just paid it, never questioned it, never knew they had the right to push back? That's the part that sticks with me. All right, I've taken up enough of your time, and I've got some things to get to out here. Go take care of yourselves. I'll see you in the next one.